96 out of every 100 stocks ever traded made nothing more than a plain savings account. 4 did all the work. And you're betting you can pick them by hand. Sit with that for a second. If you're holding 10 hand-picked stocks right now, the plain odds say most of them will trail a savings account over their lifetime. Not crash, not go to zero, just quietly lose to cash. And that isn't bad luck or you being bad at this. It's the actual shape of the market, and almost nobody tells you. Every headline is about the one stock that tripled. Nobody runs the story about the 9 that didn't. So the picture in your head is upside down. The whole market is built on a tiny handful of giant winners, hiding in an ocean of duds. Before I show you the numbers, if you'd rather be the calm investor than the anxious one, this channel is built for you. Subscribe and let's get into it. Because there's one number coming that explains why even the pros, with all their data and teams, still can't reliably catch the winners. So here's the one idea this whole thing rests on, and once you see it, you can't unsee it. The market's gains are not spread out evenly. They're wildly lopsided. A finance professor named Hendrik Bessembinder at Arizona State University did something nobody had really bothered to do before. He pulled every single U.S. stock going all the way back to 1926. Almost 26,000 companies. Nearly a century of every business that ever traded on an American exchange. Then he asked one simple question. How much wealth did each one actually create, above what you'd have earned just parking the money in Treasury bills? Basically risk-free cash. Not the headline returns. The real, lifetime wealth, measured against the most boring safe option there is. And the answer rewrites how you should think about picking stocks at all. Here's what he found, and it's the whole thing in one line. 4% of those stocks made every dollar the market ever earned. All of it? More than $35 trillion from a sliver at the very top. The other 96%? As a group, they did nothing better than safe government bonds. Not a penny extra. A wash. Read that twice. The market does not reward the average stock. It almost never has. And honestly, it's worse than just lopsided. You'd think most stocks at least make a little something. They don't. Over their full lifetime, more than half of all U.S. stocks, 57.8%, did worse than a one-month Treasury bill. Worse than cash. So the typical fate of a single stock isn't a modest gain. It's a loss to a savings account. When you buy one stock on a hunch, that's the coin you're flipping, and it's weighted against you. Okay, so the winners are rare. Just buy the winners then, right? Here's the part that should actually change how you pick. Those giant winners looked completely ordinary right before they ran. Some of them looked terrible. Think of the companies that nearly went broke, the ones the headlines wrote off for dead, that later turned into the biggest names on the market. The names that built half the market's entire wealth, and we're talking about roughly 86 companies doing half of it, were not obvious in advance. Nobody had them circled. And remember that one number I promised you? This is it. If picking winners reliably worked, the professionals would just do it. They've got the data, the teams, the computers, the whole afternoon. And year after year, most of them still lose to a simple index fund. Not because they're lazy or dumb. Because the winners are genuinely unknowable until after they've already won. And in case you think this is just a quirk of old American data, he checked. In 2023, he ran the same study on more than 60,000 stocks worldwide, and found the exact same pattern. Fewer than 3 companies in every 100 created all the net wealth on the planet. This is simply how markets work everywhere, which makes picking the next big winner less like skill and more like a guess dressed up as a plan. So why does everyone keep hunting for the one big winner anyway? Here's my honest take. because a lottery ticket feels free. That same handful of monster winners that makes picking a losing game is exactly what makes it feel like it could be you. You hear about the one person who bet everything on a single stock and retired early. You never hear about the thousands who did the same thing and lost. The story that sticks is always the winner, never the field behind them. It's why people line up for the jackpot and not the index fund. One sells a daydream, the other just works. Here's the move that beats all of it. An index fund doesn't try to outguess anyone. It just buys the whole market and flatly refuses to miss them. You stop needing to be right. You buy the whole haystack, needle already inside it, and every winner that ever shows up is already yours the day it starts to run. Now, I'm not selling you a magic trick. You still ride the whole thing down in a crash. Some years are flat and ugly, and that's exactly when most people quit and go back to chasing the hot pick. But what you're buying isn't excitement. It's the guarantee that you cannot miss the handful of winners that make all the difference over 30 or 40 years. That's the trade. You give up the thrill of the hunt, and you stop being the person the math is working against. So here's where this leaves you. Picking by hand is a guessing game where the odds say you'll land on a loser. Owning the whole market isn't settling. It's the only move that guarantees you already hold the next 4%, whoever they turn out to be. So do one thing today. Open your account and count how many single stocks you're holding on a hunch. Just count them. Then ask yourself one honest question. Would a single broad index fund just own all of them for me, winners and all? You don't have to do anything drastic this afternoon. You just have to stop pretending you can pick the 4% and start owning all of it instead. Subscribe if you want more of the math the headlines skip. Calm investors. Build wealth with patience, not panic.